What's going on, guys? Today I'm going to be talking about the best ETFs to grow rich. Of course, I mean grow rich over a long period of time, 10 plus years. This is not a get rich scheme. Be sure to like, comment, and subscribe. Really helps out a growing channel like this. I love all the feedback that you guys have been giving me lately. Really helps me motivate me to keep making videos. Of course, we're talking about ETFs, and generally the stock market goes up over time. So definitely want to start investing as early as you can, as young as you can, and you'll really reap those rewards later on in life. So what exactly is an exchange traded fund or ETF? It tracks a stock index, bonds, or a basket of assets. So rather than buying one individual stock and hoping it does well, you're buying a whole group of either stocks or bonds or different type of assets, and that way you have a mix of many different assets rather than just one company. They trade just like a common share of stocks, so you buy and sell them just like you would with any other stock. And the price of an ETF can appreciate or depreciate over time. It can also pay out dividends just like an ordinary share of a company. So, what are some of the advantages of an ETF? Of course, main one is diversification, so not all of your eggs are in one basket. If one stock does well, could be overshadowed by one stock not doing as well, and vice versa. It's also very passive. You're not the one that's actively looking at quarterly reports or staying up to news with what's going on in the market. It's whoever's in charge of that particular fund is doing all the trading and allocations. So you don't have to put in any of the work other than buying the initial share of that ETF. There's no minimums, such as with mutual funds, which usually sometimes have a higher barrier to entry. Sometimes it's $10,000 minimums. Here, it's just whatever the price of that particular ETF is trading at. It's also super easy to trade on the stock market. There's always buyers and sellers. And Warren Buffett even is quoted here saying, by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. And he says that because it's actually very hard to continuously beat the market. Very few people, even people that are professionals that get paid money, are not able to continuously beat the market. It's actually shown that an ETF over time does better than most so called professionals. So that's one of the many reasons of investing in an ETF. Of course, there's also cons. And like I mentioned earlier, you might have too much diversification, as in, if you have a few stocks doing well, it might be overshadowed by some of the less uh, performing stocks. And it could also work the other way around as well when you have stocks that are doing bad, but they're overshadowed by your upper echelon of good stocks. So there's also no control over stock selection, so this could also be a pro and a con. I personally like to research companies and use my own discretion when buying. Of course, with an ETF, you get no opinion on that. You have to do whatever the person controlling the ETF does. There's also commission and fees associated with an ETF, so they can get obviously money for providing the service. The average ETF carries an expense ratio of 0.44%, which means the fund will cost you $4.40 in annual fees for every $1,000 you invest. So here's my first ETF that I like. This is in no particular order. It's called SPY Spider. It basically tracks the entire S&P 500. And just because there's 500 companies, it doesn't mean that each particular company has an even amount of weight. Weighted a lot more since companies like Microsoft and Apple are so large. They are more heavily skewed, so they make up a bigger part of the S&P 500. Therefore, they're weighted more in the particular ETF in terms of holdings. So you can see here, SPY since 1993 was $44, is now $274. So imagine just putting in money at each of those different points of time and just watching it grow. Also pays around a 1.86 dividend. Has some very nice blue chip companies in there: Microsoft, Johnson and Johnson, Apple, Google. It's very heavily invested in technology. As you can see there, it's survived recessions in the past. Definitely a good stock to get into if you are a beginner. Second ETF we're going to talk about today is the Noble, NOBL. And this basically tracks the dividend aristocrats. As you might know, are companies that have not only paid out dividends for 25 straight years, but have also raised that dividend for each of the past 25 years. So you have companies like 3M, Dover, Exxon. This one hasn't performed as great, but it's been very consistent. Usually, if you're a dividend aristocrat, you're more focused on the dividend growth rather than the actual capital appreciation. They're usually a lot less volatile than other particular industries, such as technology. So NOBL also has an expense ratio of 0.35%, which is, I believe that's actually the highest on this list, but not too bad overall. Number 3 is MGK. No, not Machine Gun Kelly, but a Vanguard Index ETF. Here it's basically getting focused exposure to the largest growth companies in the US. So as you can see there, it has 7% weight in both Amazon and Apple, some of the largest companies that have also experienced the most growth in the past decade. 43% of its holdings are in technology, pays a 1% dividend, has a lot of high growth companies in there, but you also know they're pretty blue chip. They're not just going to go bankrupt over a long period of time. Generally, you'll probably make money here. It was $50 in 2007. Now it's grown all the way to almost $120. Expense ratio of 0.07%, which is extremely cheap. And this also helps you if you're not able to afford. Amazon is around, I believe, $1,800, give or take, depending on when you look at it. And it's obviously a high barrier to entry there, but here you can get in at just $118. You get a slice into Amazon and Apple, some of the largest companies in the world right there. And the last one I'm going to talk about is VNQ. It invests in stocks issued by Real Estate Investment Trust, or REITs. This one pays a pretty high dividend of 4.21%. As you can see there, it started at $51 in 2004, collapsed a little because of the housing crisis, but has rebounded very nicely. This has different REITs, which pay out most of its earnings to its shareholders to get tax benefits. So as a lot of the blue chip REITs, as Simon Property Group, American Tower, Public Storage, and it only has a 0.12% expense ratio, so very cheap there as well. And that concludes the video, or the ETFs I'm going to talk about. But it's very important to remember, do what works for you. So these are just things I'm comfortable investing in, but obviously for you it's going to be a lot different. So there's a lot of people that invest in gold ETFs, international, emerging markets ETFs, healthcare, any industry, you name it. Uh, and if that's what they're comfortable doing, if that's what works for them, so be it. I'm just sharing what I like to do. And of course, this is not a get rich scheme. It is a get rich over time scheme. So your best bet is to buy them and hold them. Definitely not selling them when it goes down or buying when you get a small gain. It works better to buy it now and then hold it for a long period of time. So make sure you guys like, comment, and subscribe, and tell me what you guys liked. Know I'm doing this new format where I'm actually recording the whole computer screen rather than just the Robinhood app on my phone. So let me know if you guys like it. All right, thanks, guys.